Hello, traders. It is 8:07 a.m. Chicago time on a cold but sunny day. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Bit of an issue today with the broadcasting software. It's not YouTube this time. Some licensing server problem, but it's resolved and behind us. This morning, looking at the overall picture, the market actually, at least the U.S. equities had pushed down a fair amount in the Sunday session, and are now back in range, back into Friday's range. We're still risk off following Friday's just big sale, a little fire sale on Friday. The Nasdaq is the laggard today, down 19 points or 0.26%, followed by crude oil at 58.92, 12 down 0.2%. The leader is gold. Gold's up at 13.19. The high is 13.1990, up 0.5%. No, now the equities are off, but they're not off all that much. It's not really earth-shattering or anything, but we still see that allocation is slightly to the risk-averse side, to safety. The 10 years are up 2 ticks. The Treasury bonds are up 3 ticks. And where's the Bund? Wo ist der Bund? The Bund is is down 20 cents. So that's where we stand this morning. Risk off just slightly. A couple interesting things to talk about today, but I want to highlight that today we've got on the calendar, there really isn't all that much to talk about. We did get the German IFO business climate expected at 98.5, came in at 99.6, pretty strong. The prior is 98.7 revised. And we have ahead of us just a Dallas Fed manufacturing clear calendar today. Not very much to talk about in terms of economic releases. So we expect the auction to kind of run it under its own power, of course, unless somebody tweets something about the Mueller report or something. Who knows? But that's where we stand today. As you all know, we had a pretty good sell-off on Friday, a trend day down on the indices. Let's get into our review segment and look at what we expected for Friday's session, given where we opened and what we actually got. This, of course, is completely off. Who would have thought that we would have a approximately 50-point up day following the Fed day, and then we would have a 50-some-odd point down day the following day. Quite unusual in that this day here closed above the 20-day volatility, historical volatility. We use that to figure out where the close to close is on the pit session. Pretty rare that it closes above the 2 sigma. Technically, that's only about a 4.5% probability, historical probability, and it did that on Thursday, and then on Friday it turned around and closed below the 3 sigma down band for close to close historical volatility. Very, very, very unusual behavior. Of course, the volatility had been collapsing since mid-January, and now this is picking up, and this is mostly due to this oft talked about thing out there called the yield curve inversion. And so, the Fed is pausing, and we've gotten comments from Fed's Evans and so on. And they're telling us how we should feel good about how things are going and all that. But they're pausing because they believe that they're pushing the brakes on this economy too strongly. And so keep an eye, just like, for those of you who did not attend the Ira Harris webinar on Thursday, one of the questions I like to ask for trader spotlights, whether it's a trader within our community or somebody who's with experience or whatever, we ask them 3 questions. We asked them a question where we say, if somebody near and dear to you wants to start trading today, what 3 important factors would you make sure that they know and take into account? And the one he emphasized at the end was know the bond market, understand money flows. He's a global macro trader, has been doing it for 42 years, and keep an eye on those treasuries and the yield curve, because that goes a long way toward describing money flows. He looks at, I think, the 210 and 5 over 30 or something like that. It's a lot to learn there, but the market's being driven around by the anticipation of the economy slowing down. So we got this drop, and again, my scenarios just total crap. The market did not want to test up. I would have loved a test at 28.50. That wasn't a quick ping and a run on this here. I highlight the key areas, the key test areas above 28.50, 28.50.50. and 28.58.75 right here and right here. And the market went up to 51.75, pushed through by about 5 ticks and just dropped. I did not get an opportunity to hop in on this, which would have been beautiful, before it started to rotate down and drop out of the Thursday range, which again was a surprise. So that's what happened on Friday. We essentially had a big impulse down, a pullback, and then continuation, and so on, which turned into an impulse on a 15-minute pullback to about mid VWAP, and then exceeded the low on the close for a small pop. The profile did not have very good buildup of volume, with a weak low. The profile was clearly the profile was clearly a trend day profile, down, changing things up quite a bit for us. So when we look at the bigger picture overall, we had I had talked about this being that was Tuesday. I talked about the way Tuesday closed looked like it was creating a topping kind of formation. And then I talked about it again on Wednesday. On Wednesday, we made a lower high, lower low, and it started to look like we're beginning to head back down towards 28.16 and potentially 28.08. And then Friday came in with Thursday came in with the big pop-up following the FOMC on Wednesday, and then Friday resumed the lower high, and could be the first day of a push towards 27.37 again. And so we pushed up above 28.50. We got 28.66 in the ES, and we're rolling over, and we're starting to make a push lower. So actually, on that chart, one thing I need to highlight here. Switch this over. Accumulated. And that's your delta. So delta with price has been pretty good. There's price, and there's the delta with it. Okay. And as price is sitting up top here, delta was strong Thursday, not so strong Friday. If you look at Friday, Friday made a lower low, and the delta remained near the highs. Now, delta just represents the aggressor, how many contracts were lifted minus how many contracts were hitting the bid. So it just represents the aggressor. From there, we go into the overnight session. We opened back up yesterday, pretty quiet, and then as soon as the Asian markets open, immediately drops and stays well below the mid until we get to the European markets, which open right here. And then from there, it's a pop, and actually the European markets are staying above their mid from the time they open. So we have overnight as a double distribution profile. We've got pretty good volume in the overnight, 188,000 or 288,000, and a pretty good taper up top. So it's important to see, and where we're opening is right on top of the overnight point of control, just above the mid and VWAP. It'll be very interesting to see whether or not it gets below this 2801. We've got the century figure below us, 2800. You need to watch this area here, but this low volume node overnight is going to be important to watch, 2801.50 or so. So it's we pulled back to 2801.50 or 2801, and then we pushed to 2801, broke through and pulled back from the top and held on the retest this 2801.50 area right here, 2108 quarter to be precise. So that's where we stand. It looks like it wants to continue higher, but we do have a pretty good taper on the top of the profile. So we'll see how that plays out. Now, what do we have for today? So for today, let's get this chart up. For today, this is a big mess. Boop, boop. Just looking at the profile on its own. How are we doing? No, just wanted the profile. So if you look at how this is behaving, there's balance, very poor high, continues, and there's a lot of price discovery here. You can see there's no consensus. Then we have good balance right there, like that. We have price discovery throughout. We have a terribly boxy profile here on the 18th. And then we have a profile that's price discovery. We have a profile that's price discovery, price discovery. Just looking, taking a moment, right, to step back and look at what these profiles are saying. We are not getting this, where the market's moving up and accepting higher prices, like that. This is a more orderly type of market, and it's what we have is a squiggly market or a boxy market where it's just fighting. There's a lot of activity between both sides, and they're fighting to discover where prices are likely to, what prices are considered value. From Wednesday, which we would expect, actually Tuesday, you could see the black lines, these black lines. This is a 20-day average of volume for that particular time bracket. This is a 15-minute chart, and you could see that from Tuesday we are already exceeding the 20-day average. Here we have FOMC. Right there's the FOMC. We expect that, but since then we seem to be more active. Rollovers done, so we expect things to fall back in line. We expect the average to hold prices, but what we're coming into is some volatility expansion. Expect better opportunities going forward, or more opportunities going forward. Opportunities cut both ways. We make money, but we also have a better chance of losing money when the market gets this way. So just watch yourself. So what are we expecting today? We are right above So what played out on Friday was actually Thursday's plan. Thursday's plan was a test at 2808, if you recall, and that played out on Friday. So beneath us, there's several areas of gaps. We've got a gap in the 2804 area. We got a gap at 2790 or so, which is where the overnight low is. We have several gaps, areas of repair that we've left behind, and we're likely to test these. So this morning, the primary scenario is expected to be a responsive push, assuming that 2801 quarter holds, and then I'm expecting an impulse down. Once that's done, hang out at the low, attempt to push back in, and then overall I'm looking for a downdraft, but I'm not expecting the market to run today. I expect it to hold steady. Again, expecting the range to expand from what we would consider to be normal, so looking for about 15 to 16 points or so of range, but I am looking for some reversion back, some responsive buying back into Friday's range. Secondary, open, test, drive lower, immediately take out the overnight, get below, take out the overnight low. I expect it to get below 2800 immediately, and then drift back up to finish lower yet again. So my bias is more strongly on the short side. However, there is room for buyers to step in here. As we saw, the selling delta wasn't all that strong on a relative basis for the selling that occurred on Friday. For that, I'm looking for an open rejection reverse, and then start to drift through to the point of control back into 2816, and then start working itself back up into the 2830s or so from 2800. Now remember, we do have the century figure beneath us. If we do sell off strong, then I'm looking for 2767 to be the key target below from where we are. That gives us about 30 points of range or so. That's the key target down here. I'm looking for 2767 and the potential to drive down into the gap zone at 2753 or so. So that's really what scenario 2, if it starts to accelerate. Now here's the thing. I could sit here, I do have a plan for each day, several plans for each day, but I have to respond. Don't forget that you need to respond to what the market tells you, not what you think the market should do. The market doesn't give two craps about what you think. So just make sure that you're responding to what it's saying. If it pushes up, for example, if it pushes up into the prior day's range, it's just beneath right now. If it pushes up into the prior day's range and it has a very difficult time getting to 2815 before it falls off, that is showing you weakness. Then we're not going to buy. We're going to push. We're going to trade from the short side. This is how we guard against emotional losses. So if it cannot hold the prior day's range, this is a big clue, right? So if it cannot hold the low or higher from the prior day, now if it pushes up and it's not falling back off, then we know 2815 and 2816 are the key targets above, and we can trade from that side. So if it falls out of range, sure, you can buy 2790. Sure, you can buy 2780, 2776, 2771, whatever you want to buy. But unless you're treating it as a scalp and are pushing the short side, it's really not a good long-term plan for you. You got to trade with the side that's winning, because we are not the side that creates the win. It's everybody else pushing with more dollars, more money, more power, and we just want to be on their side. Good luck today. Take care.